Kia koutou, nau mai haere mai. Welcome to this Mindful Money seminar, and it's the 9th in our seminar series. I'm very pleased to welcome Mary Holm. Mary is, I'll introduce in just 1 second. I want to say if you wanted to catch up with the other 8 seminars, you're very welcome to go to Mindful Money website, www.mindfulmoney.nz. And on the events page, you can see the YouTube videos of each of them, and we've written a nice little handy summary of them as well. So in today's session, we're talking about thinking clearly in a crisis. We're going to have about 15 to 20 minutes of discussion, and then we're going to open up for Q&A. I'm afraid we're going to be slightly authoritarian, and we're going to mute you on Zoom. Apologies for that. And the way you can ask questions, enter into the discussion, is via the chat facility. So go to the chat facility at any stage, put in your questions or comments, and then when we get to the Q&A section, we'll discuss it there. For those of you who are on Facebook Live, you can use the comment section of Facebook in order to put in your questions and comments there, and my colleague Toby will send those through to this Zoom call. So thanks very much. Without further ado, it's a very warm welcome to Mary. She needs no introduction to many people, but I'm going to do so anyway. Mary writes a personal finance column in the Herald, and has won a Qantas Media Award for her column. She has other columns as well. She's a fortnightly interview on Radio New Zealand, which actually is just finished. Some of you may have heard her on that. And something that people don't know is that Mary contributes a lot to financial policy making. She's got an MBA from the University of Chicago, and she's also an author. Her 4th book is called Rich Enough, 8 Steps for the Laid-Back Investor. Top of the New Zealand bestseller list for 7 weeks. If you look at the reviews and comments, there's a lot there about how the book has changed people's lives. So I guess no author could hope for any greater impact than that. And just this week, to top it off, Mary's been awarded the Order of New Zealand Merit. So a huge congratulations to Mary and a very warm welcome.
Thanks, Barry.
Mary, I'm going to just start off, not because we're going to be offering any financial advice, but because it's a good thing to do. I'm going to just offer a very quick statement on financial disclosure, just to tell people that we're not offering financial advice in this seminar. You should be aware that investing involves risk, and we'll talk about risk. You're not guaranteed to make money from your investments, and you might lose money that you start with. We don't provide any personalized advice on the seminar or recommendations for particular funds, and any information that we provide today is only general, and it's only current at the time. So excuse me for doing the financial disclaimer, but it is good practice, and we support the FMA and its financial regulation practices. So I'm going to kick off, Mary, with asking you a sort of a framing question. So in a crisis, one of the things that we learn is that it's crucial that people are in the right risk category for their investment. Can you explain to people what kind of factors they should be looking for in determining their risk profile?
Yes, there are only really 2 main factors, and one is how soon you expect to spend the money. So talking about KiwiSaver here in particular, if you're planning to spend it within 10 years on either a first home or on spending it in retirement, then it's a really good idea to be in a lower risk fund, because otherwise the markets might go down, as we've seen they did recently, and right at the point where you're planning to spend the money. So So the basic idea is if you're within, say, 3 to 10 years of spending the money, it's a good idea to be in a moderate balanced fund, a middle level fund. And if you're within less than 3 years, it's a good idea to be in one of the lower risk funds. But if you've got more than 10 years in hand, it's a really good idea to go into the higher risk ones, because they always, in the long run, give you higher returns. They're much more up and down, but in the long run, the returns are always higher. But the other factor, so that's one factor, how soon it is before you spend the money. The other one is how much you can tolerate the ups and downs of the market. And a lot of people have learnt to their cost in recent times that they couldn't quite stomach the share market plunging as much as it did. It was pretty radical drop there for a while in March. And they worried, some say maybe even panicked, moved to a lower risk fund. And that's a really bad thing to do, because as we've already seen, the markets have actually recovered unusually quickly from a downturn. And we don't know, there could easily be further downturns. There easily could be, because the economy is going to take, all the economies around the world are going to take a long time to recover. So have you got those pictures there, Mary?
Sure. So I'll just bring up the pictures if I can. So should we do world data first?
Yeah, that'd be good. Yes.
There we go. That should come up.
So this is just showing the last year of the MSCI World Index, which is an index of all the big companies, the big shares around the world. It's about half of them are about American companies, and then all the other companies in the world. And all the other big ones, there's several thousand in the index. And you can see how the market was, steadily trucking on up through 2019, and then suddenly plunged in March this year. But you can also see how it's regained about 2/3 of that loss already. So it's back about where it was in August, September last year. And if you've got the New Zealand one,
yeah,
Barry,
let me bring up that.
Yes, it's a very similar pattern, surprisingly similar actually, because they don't always move so much in unison. But when we get that one up, you'll see that the New Zealand market's recovered even more than the world market. It looks as though it's about 3/4 of the way back up again now.
Sorry, Mary.
It's all right. And look, if you can't find it, it's a very similar picture to the world one. We're back up now to about where we were in November in New Zealand. We're about 2/3 of the way, 3/4 of the way back up again. Absolutely no, that's the world one we've got again.
Sorry, I haven't got the New Zealand one at hand. Yeah.
No, look, never mind. There's absolutely no guarantee that the recovery will continue, but it just goes to show what can happen to people who panicked when the markets fell and got out, and they've missed all of that recovery. If they're moving back now into a higher risk fund again, they've lost all those gains. It's a horrible, sad story. Yeah.
So I think the data was a $1.4 billion shifted from growth funds into conservative funds. Is that about the right number? And I guess the concern then is those people kind of locked in the losses that they had made as they moved to a more conservative fund.
Make the losses real. Yes, I don't know what the total number was. Interestingly, though, I was just looking at, in fact, talking on the radio about it, the Commission for Financial Capability did a survey during lockdown, and it was only about 7% of people who did move from a high risk to a lower risk fund, which is, I was gratified to see that. There were quite a few more people thinking about doing it, but not that many people actually did. And the point is, though, if whether or not you did move to a lower risk fund, or you still thinking you'd quite like to, because you've realized now that you're not very good at just hanging in there when the markets go down, that you just haven't got a stomach for it, then you want to work out what level of risk you want to be in, but just move to it gradually. Don't move the whole lot at once. So if you move, say, a quarter of your money now and a quarter in a month's time and a quarter a month after that, that's the sort of way to do it. So you don't end up, because we simply don't know, nobody knows. Don't let any expert fool you. Nobody knows when would be a good time to move money from one fund level to another. But if you do it in dribs and drabs like that, then you're not going to end up moving the whole lot at what turns out to be a really bad time.
Yeah. So just maybe to add for people, there's a risk calculator on the Sorted website, and Mindful Money has the same Sorted calculator on our website for people to see, to help work out your risk category. For people who have just joined, I'm Barry Coates from Mindful Money. I'm talking to the financial columnist and author, Mary Holm. So welcome. We've just been talking a little bit about some of the mistakes that people can make during a crisis. Mary, there's a specific question I wanted to ask you, because it's come up quite a lot. We hear financial advice to people to say, stay where you are, because you shouldn't lock in your losses. But I think sometimes people think, oh, well, I shouldn't shift funds at all, rather than the advice is more about don't shift from a high risk category to a low risk category, because then you might lock in your losses. But if you want to shift from one growth fund to a better growth fund, then actually you're not locking in your losses at all. Is that correct? Can you help people understand that? Because I think there's a perception that people shouldn't be shifting their funds at all.
Yes, I know, I agree. I've had quite a few letters from people about that. And yes, so there's an important distinction. It's fine to move from one growth fund to another growth fund, or one balanced fund to another balanced fund. There's no right or wrong time to do that, but it doesn't matter that much what the market's done, because you're coming out of, you're selling and buying at the same price, basically. And so it doesn't matter. And in fact, I hear that quite a few people have been, during lockdown, some of them have had a bit more time, and they've been having a look at their KiwiSaver. And in fact, I've got a sort of KiwiSaver warrant of fitness on my website for people to go through and check that they're in the right fund for them and the right provider and all of that. And one of the issues, obviously, for a lot of people these days is whether their funds is ethical as they would like it to be. And your website's brilliant for people establishing that. And people are saying, oh gosh, well, I've looked through and I would like to get into a more ethical provider, but Mary's saying don't move right now, and I'm saying don't move from one risk level to another, but it's fine to move from one provider to another. So if you decided, let's say, to move from a not very ethical fund into an ethical one right now, so you're switching to a new provider, I wouldn't change your risk level at the same time. You can move to the same risk level with a new provider and then gradually move to the risk level you want to be at that point. So there is that clear distinction.
Good, thank you for clarifying that, because I mean, in a way, we had a downturn of people coming to the Mindful Money site because people misinterpreted this as being just stay in your same fund, whereas we'd like people to be able to find a more ethical fund, and they can choose whatever risk level they think are appropriate and stay in the same risk level if that's appropriate.
Yes.
So Mary, can I carry on? So you talked about the future, just started talking about, so there's no right time to kind of pick the market, as it were. Can you give people sort of some observations from your experience about what you think some future scenarios might be, or you mentioned, for example, the strategy that if people are going to put money back in the market, they should do it in a staged way. So there's some suggestions around how people can kind of move through this crisis in a way that that is sensible for them.
I can't think of much else to say other than moving in steps. If you are clear that you can't tolerate high volatility. What I'm hoping is that quite a few people who did panic a bit this time, or at least feel insecure about the drop in their fund value. The thing is that ever since KiwiSaver started in 2007, within the first couple of years, there was a global financial crisis, but most people weren't either not even in KiwiSaver yet, or they had so little money in there that they didn't really notice. And if you've only got a couple of thousand in KiwiSaver and you're feeding in $100 a month into it, then a drop you don't notice it so much. But and since that global financial crisis, the markets have been pretty steadily moving up. The odd dip, but they've been quite small, to the point where it was getting to be quite worrying, because I was thinking, people think their market, their investment's just going to grow and grow and grow, with the odd little blip going along the way, and inevitably there would be a big drop, and sure enough, we've had one. And so people have said, oh God, I can't cope with that. But perhaps have a look at the fact that the markets have recovered, and even though they will go down again, they absolutely will, by that much or more, sometime in the next 10 years. We just don't know when. They might not in this COVID crisis. They might continue to just grow steadily. It's absolutely impossible to tell. It's not related to the economy. The economy, we all know unemployment is going to increase in New Zealand, and output's going to go down, and all of that unfortunate stuff is going to happen in the next couple of years. But that doesn't mean that the share markets will go down. The share markets react to what people think is going to happen in the future in the economy, and that's why when we suddenly all realized this COVID thing wasn't just something happening in China, everyone said, oh my God, the share market's going to, company values are going to go down, and sold their shares, and that pushed the share market down straight away, really, and could have done it too much. The drop might have been too big, and that's why, in terms of reflecting the economic reality of the companies that you're investing in, and perhaps that's why it's come back largely back up again. But it's kind of the collective forecasting of ordinary people and fund managers, etc., what they think is going to happen to the markets. And the fact is that, especially at the moment, people just don't know. So we know the economy is going to get worse, but we don't know necessarily that the share market's going to get worse. So I say to people, stick with your growth fund if you're in one, or a balanced fund, knowing that it might go down again, and it might even go down more than it did this last time, and it might take longer to recover. Sometimes the global financial crisis took a year or so for things to get back again. It might even take longer than that. But so if you can learn from that and learn, okay, I did feel uneasy last time, but I can cope with it this next time, you'll end up with more money. It's clear. It always has been the case.
Mary, I wanted to come back to the broader context, because I think very usefully you put the management of money into a broad context of people's lives. So I wanted to come back to your book, and I'll just share that the book title for people in case they haven't seen it. And I think the title is really interesting. So, Rich Enough, a laid-back guide for every Kiwi. So can you, without sort of giving away all your secrets in the book, can you talk a little bit about the approach of sort of money in a broader context, and
Yes.
money related to happiness, and because I thought that was such a refreshing message for people.
Yeah, so it came out of when the publisher, HarperCollins, first approached me and said, will you do a book? I said, oh no, I've done too many, and didn't make much money from them, not that interested anymore. And then I said, well, what I am actually interested in is the relationship between money and happiness. And so the guy from the publisher said, no, tell me more about that. So the context of the book is the beginning and the end of the book. I talk about how money is related to happiness, and the very basic message is that, and if you haven't got enough money to put shoes on your children, of course having more money will make you happier. But once you get to a certain sort of comfortable point in life, having more money doesn't necessarily make you happier. And in fact, there's some really interesting global research, including New Zealand, that suggests that beyond a certain level, people with more money than that aren't as happy. People always say, oh, what's the level? And there's different numbers for income and wealth. And in a way, it doesn't matter. Think about it for yourself. But it's just, the details are in the book. But it's really interesting to think about the fact that getting more money is not necessarily what it's all about. And so then there are 8 steps in the book to kind of get your financial act together so you've got enough money. Because it's not about your income, it's about how you handle your money. Get that all set up. But unlike a lot of other endeavours in life, spending more time reading and worrying about your money doesn't actually make it better. A lot of most other things in life, the more time you put into it, the better it is. With money, you actually get things set up, including getting into the right KiwiSaver provider and the right fund. And, mindful money's terrific at that, because you can not just say, I want a more ethical fund, but emphasize which particular aspects are more important to you. I mean, Barry, you know this way better than I do, but whether it be cruelty to animals or environmental issues or whatever. So that's definitely part of getting your financial act together. But once you've done that, once you've got this stuff sorted, you can actually not spend much time on your money at all. Maybe once a year, just review things for an hour, but get on with spending time with friends and family and out there in nature and all the other things that are so much more likely to actually make you happy.
And I think increasing numbers of people are recognizing that, in the old saying, money doesn't necessarily make you happy. And I love I did some work a long time ago on the Bhutan measure. Instead of having GDP as measuring kind of our wealth, they had the measure of gross national happiness,
yes,
which I thought is sort of, it's a lovely message to say, actually, some things about our quality of life are more important than money. And I guess when people are surveyed in New Zealand about what's important to them, always things like family and health and well-being are far higher than the amount of money that people have.
Yes. And, in New Zealand, Treasury is now, when it looks at different proposed government policies, looks at them through a whole lot of lenses, including environmental, social, impact on inequality, those sort of things. Have a look on the Treasury's website, people. It's really encouraging to see that the governments, and I think this started under National, so it's not as if it's only the Labour government, although the Labour government's furthered it. But in New Zealand, we're not quite to where Bhutan is yet, but we really are looking at the impacts of financial stuff on a whole lot of other aspects in life.
Great.
It's great.
So if you've just joined us, I'm Barry Coates from Mindful Money. I'm talking to Mary Holm, and we've been talking about sort of basically sound ways to think yourself through in managing your money in a financial crisis or a COVID crisis. And I encourage you all to put some questions down in the Zoom chat box or in the comments section of Facebook Live. So Mary, if it's okay, I'm going to just pick up 1 or 2 questions from the chat.
That'd be great.
Good. So Patricia says, I want to change my balanced fund to another KiwiSaver provider, but they don't actually have a balanced fund. They just have a growth fund. And she says, I'm 69 and I feel stuck.
Gosh.
Do you have a comment for Patricia?
Yes, I do. I don't know that I know of any KiwiSaver providers that only have a growth fund. That's very unusual. I do know that providers might not have a fund that's called balanced. If you go onto the KiwiSaver fund finder on sorted.org.nz, you can key the name of your fund in, and up will come some really interesting information about your particular fund, including whether it's actually where defensive is the lowest risk, and then you've got conservative, balanced, growth, and aggressive. And so if was it Barbara?
Patricia.
Patricia. If Patricia, if that provider really doesn't have any other funds, find another one. I mean, the vast majority of providers have balanced funds, even if they call it something else.
Yep.
Yeah.
And that same, I should point out, that same category of balanced funds or defensive funds or aggressive funds, we use also on the Mindful Money website. So people can go there and find out what risk level the fund is, but they can also find out what kind of things that the fund invests in, what sort of companies, and whether or not they, for example, they invest in weapons or in tobacco or fossil fuels, etc. I've got a question from Marion. She's got a KiwiSaver account, but she wants to invest outside of KiwiSaver in order to diversify her funds. Yeah. So how does she choose the right investment company? What are the things she should be looking for?
Yes, well, I mean, one thing is the ethical type investing, and you can get that information. Barry, have you got on Mindful Money non-KiwiSaver funds yet, or?
A very good question, Mary. We're working hard on it, and we will be launching it in about a month's time.
Okay.
So that will be all other managed funds apart from KiwiSaver. So we've already got KiwiSaver there, and it's all the other managed funds that we'll add as well. And there's 450 of them that are available to the New Zealand public. So it takes a while for us to sort through what 450 funds are invested in terms of all of the companies, including the companies and the funds that they invest in. So literally there's millions of records that we have to go through, but we're almost there, and we should have it ready in a month or so.
Good on you. Good on you. Yes. So, so on the Mindful Money website, anyway, even if you now Marion is looking at non-KiwiSaver investments, but nearly all KiwiSaver providers offer a range of funds of different risk levels in KiwiSaver, and then in parallel another range of funds outside KiwiSaver that are very similar. So I say to people, find a KiwiSaver provider who you like and check, have a look on their website, or just email them or ring them up and say, have you got a similar fund to this that's outside KiwiSaver? Because then, of course, you've got access to the money. Apart from the ethical issues, I recommend people go with low fees. People always want to go instead with high returns, and of course you do. The trouble is that high returns in the past aren't repeated, and I mean that really is, it's not just a kind of cliche, it's really true. A fund that's done very well in the past might turn around and do really quite badly in the future. They're all over the place, the returns in funds. And there are some providers who say, well, that's not true of me, Mary, but my growth fund has just kept on being one of the top performers in the last 5 years or whatever. But next year it might not. I mean, there's history, is that heaps and heaps of research shows when you look at funds that there's no past performance is not a guide to the future, but fees are. The ones that have got low fees tend to continue to have low fees. And there are a few providers who have actually reduced their fees in recent years, every now and then, and I don't think any would dare to raise them because, for one thing, the Financial Markets Authority would be very crabby with them. But so if you look on the KiwiSaver Fund Finder on Sorted, that ranks helps you find what type of fund you should be in, and then ranks all the funds of that type by fees. And I suggest you look at the low fee ones, and then also have a look at how ethical their investments are by moving over to Mindful Money and checking out what they say about the fund, and whether it be a KiwiSaver one, or so you found one that's KiwiSaver, ask that provider if they've got a similar one, and they nearly always will.
Cool. Mary, I've got another question. It says, I cashed in my KiwiSaver at age 65.
Yeah.
I'm now 71. with negative interest rates coming next year, should I open a KiwiSaver? So this is probably somebody who put their money into a term deposit or a short-term facility, and they're now saying, should I open a KiwiSaver? And I guess related to that, I have seen a comparison of funds to say that KiwiSaver funds are slightly lower fees than the comparable funds that are not KiwiSaver. Can you confirm that?
Yes, there's a tendency for the KiwiSaver fees to be a bit lower, perhaps because the government or media are watching them more closely or whatever. But now the first point is negative interest rates coming next year. Well, probably not at the retail level. In fact, my Weekend Herald column that I've just finished with this Saturday has got 3 Q&As about negative interest rates. The general feeling is they probably won't happen for you and me. The big institutions maybe, but nonetheless, the rates are going down, and they could quite possibly go to zero, and they might go negative. So that's one point. I reckon, yes, it's great now. They changed KiwiSaver, I think it was about a year ago, where they let people over 65 join. Before that, if you were already in, you could stay in, but this particular person has got out. So anyone could get in at any age. And yes, I mean, one quite good option, given that bank term deposits interest rates are so low, would be to get into a KiwiSaver fund and go into the lowest risk ones, that they're called defensive funds, and they are probably slightly riskier than bank term deposits, but only in some ways. We did an interesting analysis in my column a while. In some ways they're less risky, and in some ways they're more risky, because they will invest in the products of quite a few different banks. They're basically buying the equivalent of term deposits in several different banks. So you've got a spread of banks, and the fund managers are watching out to try and get as good an interest rate as they can. Or if yours, now our viewer was 71, I think. I think it was mad, wasn't it? Yeah.
We don't know, sorry.
Don't know. Anyway, that person is quite likely to live well into their 80s, possibly well into their 90s. And so it's a good idea to set aside some of your retirement savings and say, I'm not going to be spending this for 10 years or more, and putting that into a higher risk KiwiSaver fund, because in the long run, you will get higher average returns. You have to be able to tolerate them going up and down. But certainly there's no need for people at the beginning of retirement to suddenly make all their money low risk. That's not a really good strategy.
That's a really good reminder in a sort of an era where average life expectancy is continuing to rise. Yes. That sure. If you are from a long longevity family, then you may well be needing income at age 90, and maybe you don't need quite so much now, and maybe a growth fund is quite appropriate.
Yes, and I mean, people often ask me, well, how much should I spread my money over my retirement? If I retire at 65, I don't know. I might live to 100. Don't know how sort of fast to go through my money. But over and over again, people who are over 85 and certainly over 90 say that they find New Zealand super is enough. Now, I know that there's worries that New Zealand super will go down, but when you look at the Treasury numbers, it probably won't go down all that much relative to what it is today in terms of its buying power. So I think it's fine to plan to spend your retirement money by 90 and then, just live off New Zealand super, or perhaps at that point get a reverse mortgage and start using a little bit of money that's tied up in your house. That's a totally fine strategy.
Yeah. Mary, that raises a particular point. You were very much involved in the review of retirement policy by the Retirement Commissioner recently, and one of their recommendations was that there should be a greater emphasis on the fact that New Zealand super will be available to people over the long term so that they can feel confident about it and depend on it. I thought that was a very good recommendation, because still some people are a bit insecure about whether they will have future income. So,
Yeah.
but there are one or two other recommendations that haven't been acted on by the government, and I guess the government's response is due in a couple of months' time. But do you have any particular policies that came out in the review that you're particularly keen on, or that you would like to see enacted?
Well, funnily enough, one that I was just talking about on the radio today, but I hope not too many people are finding this repetitive, but the idea of a sidecar to KiwiSaver is what we're calling it, where people put an extra 1% of their income in, and it goes into a little side fund until you get 3,000 in there, and then after that it just goes into your KiwiSaver, and that 3,000 is readily accessible in an emergency, so it's not nearly as hard to get out as KiwiSaver hardship withdrawal. And then once you get it out, then you build it up to 3,000 again. It's a voluntary thing that we suggested in the Commission's review, that people don't have to do this, but that it be a default thing, so that with an employee, when they get signed into KiwiSaver, this happens unless they say, hey, no, I don't want to have an extra 1% taken out of my pay. Now, people who are not employees, wouldn't happen automatically for them, but there should be a provision for self-employed people like me, and probably you, Barry, and non-employees. There's a lot of people out there who are not employees who could also set up this, so that there's a little emergency fund sitting there for you.
It's a nice idea.
Yeah.
Another question from Sarah, who says, I'd like to start KiwiSaver for my kids who are 16 and 14 years old. Is there any government benefit offered to do this? And if not, would I be better to just use a managed fund?
Yeah, no, interesting. You don't get any money from the government until you're 18, and in the year you turn 18, you get proportionate to how much of the KiwiSaver year you were 18. But that's a minor point. But it starts at 18, where the government's putting money in, and at 18, it's compulsory for employers to put money in. So quite a lot of teenagers might have a little part-time job, and until you're 18, the employer doesn't have to put money in, but quite a lot of them do. I mean, quite a lot of them are generous. After all, they're not paying the teenager a heck of a lot of money, and so add another 3% into their KiwiSaver is just a nice gesture. But the other thing about it is, the positive thing is that it's getting the kids started on a first home fund. For most of them, that's and getting them into the habit of being in KiwiSaver, so that when they get a job, their money's automatically going into their KiwiSaver account, and it's all rolling along there. The downside is that the money can only be spent on a first home and in retirement or hardship withdrawals, etc. But so it can't be used for, say, tertiary education or starting a business or something like that. And so some people are saying, I'd rather save for my children elsewhere, where there's more flexibility on how to spend that money. And that's totally legitimate. But when the kids are getting to 18, and quite a few people, their young ones are turning 18 while they're in tertiary education, and so the student isn't really in a position to be contributing to KiwiSaver, or not contributing much. And that's when it's a terrific idea for the parent or auntie or grandparent to set up some automatic transfers into the young person's KiwiSaver account, so that they are getting the 1,043 a year in there, or as much as possible, maybe only 500 a year. The point is that for every dollar you're putting in after you're 18, the government's putting in 50 cents. And that's a really good boost to somebody's savings. What it means in the end is, instead of retiring with 100,000, you're going to retire with 150,000. It's very powerful, that extra money coming in. Yeah.
Cool. So just as a reminder to people, if they haven't put in their funds into KiwiSaver and want the government match, then the end of the period is the end of June. So now would be a very good time to contribute if you're self-employed, for example, and you haven't been putting in regular contributions, or if you have an 18-year-old over dependent, or a nephew or a niece who you want to support, now would be a good time to do that.
Yeah, Absolutely. Yeah.
So Jill says, I want to move my investments just to New Zealand companies. Would it be possible to specify that to my provider?
No. What Jill needs to do is find a fund that invests only in New Zealand investments. The provider won't. They just putting your money into one big fund that all their growth fund people are in, or all their whatever. So they can't do that. But you can find funds that invest only in New Zealand shares. It's a little bit. You don't have that information on your website, do you, Barry?
We do. We have a description of the funds, which identifies those that are New Zealand oriented funds.
Oh, do you? Oh, that's good. So that's one way to do it. I do know Superlife is one provider where you can invest in a fund that's only in New Zealand shares.
Quite a few of the providers do. So a number of the KiwiSaver providers and a number of the managed fund providers. So I guess there's quite a few options across most of the risk categories and the mixture of either shares or in bonds for people to invest in.
That's good. But I mean, I must say that a lot of the growth funds have a lot of, and aggressive high risk ones have a lot of overseas shares. And in general, I recommend that. I recommend having your investments around the world because it's just another level of diversification. If the New Zealand economy got struck by foot and mouth or an earthquake or something like that, that could cripple our economy and not other economies, and then you might be very glad your money spread further. But on the other hand, Jill, I think it was, might be sort of feeling she wants to support local, and that's fair enough too.
So I'm going to ask you one more question because we're pretty much out of time. And it's from Ursula, who says, Mary, can you speak a little bit about your background, your study and your work, and how you got into the work that you do? Because Ursula's saying, I might like to do something along the same lines myself. So can you give us, for the participants, a sort of a closing note on your personal journey?
Oh, gosh. I'm basically a journalist. I'm not an advisor. I've been a reporter on newspapers, 8 different newspapers in New Zealand, Australia, and America, and zeroed in on financial journalism, and ended up coming back to New Zealand to be business editor of the Auckland Sun, which lasted 1 year, and then the Auckland Star, which lasted not many more years, and then the Listener. But then I went out on my own, and so since then I've been writing columns and doing radio and books, etc. But basically, I'm a journalist, not an advisor. So that's maybe. But I've also been on a couple of boards in the meantime, and Financial Markets Authority, etc. I might just give a quick plug to Financial Services Complaints Limited, which is a board I'm on at the moment, which is like the Banking Ombudsman scheme. And the thing is that most New Zealanders don't seem to realise, if you have a problem with any financial service provider of any, whether it be a bank or a financial advisor or a stockbroker or a KiwiSaver provider or anyone that's doing anything financial, they all now must be in a disputes resolution scheme. So if you have a problem with them and you're not happy with how they resolve it, you can go free to, they have to tell you who the disputes resolution scheme is, and this one I'm on the board is one of them. There are 4. And then it's free to you. They listen to your side of the story, they listen to their side of the story, and they might make an award of money. Sometimes it's just an apology, but sometimes that's very satisfactory for people. So just know, everybody out there, that if you've got any problems with any financial service provider, there's free help there, and they're very unbiased. They look at both sides of the story.
Cool. Thank you very much, Mary. And that was really interesting, and I'm so glad you came on the program, and thank you for all the great work that you do and kind of helping people on their finances.
Oh, thanks, Barry, and thanks everyone for watching and sending in questions. It's been neat.
So my apology to a few people whose questions we didn't quite get to. I'm just going to finish with an announcement. We've been doing these as weekly seminars. Every week we've been doing them at 4 p.m. on Thursday, and this is the last one we're doing at 4 p.m. on Thursday. We decided to go for that time during lockdown, and now many people are back at work and it's not very convenient, so we're switching. So next week we're on at 7 p.m. on a Wednesday. So that's 7 p.m. Wednesday, the 10th of June. We've got somebody called Simon O'Connor, who runs an organization called the Responsible Investment Association of Australasia. And Simon and I are going to be talking about some really interesting things about what governments can do to rebuild better, rebuild the economy back better around sustainability, around climate change, around better social outcomes, and how that relates to ethical investing. So we'd love to have you all come and join us. So you can register on the Mindful Money events page. That's www.mindfulmoney.nz. And that's a place you can also catch up with a copy of this video, which we'll post very quickly. And it'll also be on Mary Holm's website, which is www.maryholm.com. Isn't it, Mary? Yeah, .com. Yes. And on the Mindful Money website, you can also see the past 8 videos in this series. So thanks very much for joining us. Thank you once again to Mary, and congratulations on your award, well deserved. And I hope to see some of the audience back here for next week's seminar. Thanks all.